Thank you, Jan Hendrik, for a really good presentation. And we didn't plan this, but it's a really nice background to the discussion we're going to have now, which actually dives a little bit more into taking a theoretical structural approach, and actually will answer, hopefully, not answer exactly, but take us a step closer to answering some of these questions. Just quickly, thanks to Bashir, Claudine, and ERSA for organizing this. It's really a privilege to be here to actually contribute to this discussion. It's really important. Okay, Chris, if I forget to mention about zero lower bound, please ask me. This is my, it's a pet peeve, but if I forget. Okay, the title's a mouthful. You probably read it already, but I want us to take a step back. I'm here especially hearing the discussions now, valid questions, but I think we're missing something that's quite fundamental, first principles about a market-based economy. So let me ask the question, what is a price? Right? A price is a signal wrapped in an incentive. So if we see a higher price, that signals scarcity in a normal market. What do consumers do? Shift to alternatives. Puts downward demand pressure, brings the price back. What do producers do? They see a profit-making opportunity, ramp up supply. What does that do? Bring downward price pressure again. Okay, what do entrepreneurs or entrepreneurs do? They see this higher price, innovation, look to innovate, to make alternatives, or do an Elon Musk, try to cut down the costs of production. Okay, so this dual purpose of prices as information paired with motivation is absolutely critical in the efficient allocation of resources in a market-based economy. Trend inflation distorts this. There's a cost, and it distorts relative price signals. This is effectively what we're doing, and we're casting this in within a DSGE framework, a general equilibrium framework, and we're going to look at disinflation policy, and specifically also thinking about the long-run costs versus the short-run, the long-run gains versus the potential short-run costs. Okay, so three aims of the paper is to look at trend inflation and how does its effect on price dispersion, as you've seen previously, under trend inflation affect macroeconomic dynamics and household welfare. Then we want to look at the disinflation policy trade-offs that the South African Reserve Bank is sort of hinting towards. What are these long-run gains versus what are the potential transitional costs of this policy move? We then will consider policy coordination, not specifically optimal coordination or anything like that, but we introduce a role for fiscal policy, and we really want to understand how does government debt shape this disinflation dynamics or the strategy. And then again, Jan Hendrik also sort of pointed this out in the Codera document, how can we sort of look to mitigate the short-run costs of disinflation? Today I'm going to focus mostly on 1 and 2. We do have some tentative findings on 3, but effectively what we've seen is that this is 2 papers. There's a lot to unpack, and we need to actually split this out. Okay, I'll quickly run through some of the literature. This is Scari and, I don't know how to pronounce it, Spordone. Does anyone? Spordone. Thanks. Is an excellent paper. Any macroeconomists in the room, this is a Journal of Economic Literature paper. It is a must read. It is dense as anything. It is a fantastic paper. Okay. Essentially, trend inflation matters for policy analysis, with the identification of the sources of persistence, the extent of cyclical trade-offs. What we also see is that at higher levels of trend inflation, it requires more hawkish policy. I have an estimate in the appendix where we estimate the model with and without trend inflation. I mentioned it to Nicola the other day, some others. When you do this, you actually get a much higher coefficient on the weight of inflation in the Taylor rule. We don't know, I know the SARB people don't like talking about a Taylor rule, but it basically suggests that we underestimate the reaction function of the SARB to inflation when we don't take into account trend inflation. This breaks divine coincidence, trend inflation, through this price dispersion cost. Okay? It affects productivity. We also introduce wage stickiness, so there's wage dispersion. This creates a wage in the labor market. Okay? So misallocation of resources or an inefficient allocation of resources. Divine coincidence also breaks under heterogeneous households, all right? There is a heterogeneous agent literature that shows this. In that literature, you actually can get quite high optimal inflation targets, around 8-10% actually, all right, with downward wage rigidities. We look at the two-agent structure, and this is also sufficient to actually break divine coincidence, and I'll get back to this, with wage rigidity. There's a number of papers on this. We also speak to the credibility of the inflation target that will require the public's belief on whether government will respect that commitment. And there's a good paper by Krause and Moyen on the role of trend inflation and public debt. We're essentially bringing these three elements in. This is essentially our contribution, is to bring these three elements together and also have this application to South Africa. I also want to cast this, it's also part of a broader research project. I want to cast this within the generally information frictions environment, because I think at its heart, trend inflation that distorts relative price signals is an information friction. And you can read the definition, but I want to quickly go through because I'm running out of time. But effectively relaxing this perfect information assumptions can yield more, or yields more realistic policy analysis framework. We touch on this a little bit. Yeah, we have some results on this, but just for like sort of illustration purposes. And secondly, good work by Sims and Garin. Price dispersion reduces efficiency, widening the gap between actual and potential output. There's a whole fiscal story. Let me skip over that for now. Okay, this has been mentioned, right? Optimal inflation target in theory versus practice. Most sticky price models, without trend inflation, 0 is your optimal target, always. And that's why if anyone knows this DX plot, where you see all the dots are basically, the majority of them are on the 0 line, and there are these few exceptions that are spread out all over the place, and they tend to be quite ad hoc or specific to the 0 lower bound, for example. Okay. In practice, central banks, we know, set a higher inflation targets, and, you know, the reasons given in a more practical policy setting are about measurement imposition, the 0 lower bound, or deflationary risks. Okay. So there is obviously this challenge in determining what an optimal inflation target is, especially one tailored to South Africa. And there's just a little shout out to AI Help, trying to looking at the broad set of literature, and it's very interesting what pops out for South Africa. So I encourage you to go look at some of these artificial intelligence sites that do these searches. You'll see some interesting findings that are quite counterintuitive. But there's this general lack of consensus, and I think this has been pointed out already. I do think it is a bit of a red herring what the point estimate is. I know we want this point estimate, but you'll see now in a second as I go through, I think we sort of have quite similar ideas to what Kadera was pointing out. Okay. Main findings of the disinflation policy. We do see long-run gains, long-run output gains from lower inflation target that are quite significant. For household welfare, right, lower is better, but what we're seeing now is it's not necessarily 0. Okay. Short-run costs of the disinflation policy, when you're not capturing the fact that you're actually coming down to a lower trend inflation, right, which is reducing price dispersion costs, price and wage dispersion costs, that this actually mitigates these short-run costs. And this is not ever spoken about or captured in analysis. Very rarely, all right? You'll see this in the results. Transfers to poorer households, which are going to be financially constrained households that don't have access to finance, can mitigate these short-run costs as well. But what we see, and we're still digging into this, is that government debt dynamics complicates the picture. Okay? There are these trade-offs that was mentioned earlier about reducing inflation will reduce the term premium in the long run. That has this benefit of flipping our R minus G, which is currently positive, right? Not good for debt sustainability, but at the same time, it can raise the real debt burden. However, what we're seeing, at least with the simulation results that we calibrate to South Africa, partly with estimated parameters as well, is that when you're at higher levels of trend inflation, let's say coming from 6 to 5 or 4 to 3, in the long run, the debt to GDP ratio can actually fall. All right. Even though debt rises, real debt burden rises in the short run. It's because of the output gains. Credible communication is going to be very important. How long do I have? Okay. I want to just give a high-level overview of the model. I've mentioned a little bit about this, but essentially we've got this two-agent New Keynesian setup. We have two different types of households. Ricardian households that have access to finance and can smooth consumption. Non-Ricardian households or poor households are excluded from financial markets, and effectively they can only consume their wage income and whatever transfers they get. So much more volatility. Okay, this is a sort of in between. You have the rank, tank, and then Hank. If you know this, there's some other ridiculous acronyms, and I don't like them. Gideon, my friend, will probably have that role died now if he saw me write tank on there. Of course, we're introducing nominal rigidities, which are critical in the New Keynesian setup to generate these real costs. Okay. Key is the Sascari and Spordone paper of introducing a generalized New Keynesian Phillips curve. It's actually a generalized New Keynesian model, where now trend inflation is positive. Okay. And this creates this real cost from price and wage dispersion. Monetary policy follows the standard sort of Taylor type rule, where the objective is to stabilize inflation output. We also allow for time varying and positive inflation target. Divine coincidence is not possible. One, because of trade inflation, but two, also because the output distribution between the two types of households is not the same. What is divine coincidence, right? That's the famous Clarita Gali Gertler paper, where you stabilize inflation and output gap, you maximize welfare. Okay, you don't get that necessarily. Fiscal policy raises revenue, spends, and redistributes. Right? We look at 4 fiscal instruments. We actually abstract away from physical capital in this framework. I think it's reasonable, actually, over the timeline. The model gets really big if you do. We look at risk premium, and we do have a debt maturity structure, but we don't have yet results on this. But there's some interesting things we can do later stage on this. Okay. This is speaking to Jan Hendrik's presentation. So firstly, the obvious question is, okay, you've got a model that obviously has some prediction about the implied price dispersion dynamics. Okay? We need to actually at least try and validate this before we proceed. So what we're plotting here, okay, I've just shown in a reduced form the log linearized price dispersion, okay, because we have non-linearities in the model as well, but it's easier just to write in log linearized form, where there's some weight on inflation. So price dispersion is increasing inflation, okay, and that's supposed to be VP as well. So there's also persistence in price dispersion. All right. It's also increasing in trend inflation, the Calvo price setting parameters. So the more sticky prices are, this raises price dispersion and the elasticity of substitution. Okay. So we can plot this from the model. So what I do, we can take CPI data, okay, the inflation data. We can argue about what measure to use, headline, this and that, but I just take headline CPI. Feed it into our model. What series do we generate? Okay, great. So CPI is the green line, all right? The blue line is the nonlinear version of price dispersion. The red dotted line is the log linearized version, okay? This dotted purple line is the diffusion index from Codera, right? Which is effectively measuring the share, you can correct me if I get it wrong, Jan Hendrik, the share or the proportion of prices that are rising above the midpoint. Okay, it's crude. I was very surprised when I plotted them together that they're very, very close. Okay, it's not like I'm getting something that's totally opposite. The correlations, the diffusion index is correlated about 0.68 with inflation, and our linearized one is about 5.4, and it goes up to about 0.6. For the nonlinear version. So there's this tight link. At least our theoretical model is doing a decent job in predicting a crude measure of dispersion or diffusion. Okay? I need 5 minutes more. Thanks. Okay, let's go. The cost of price dispersion. So what we can do is look at the steady state solution of the model and change the parameters. So this is the Calvo parameter I mentioned, right? Increasing that, increasing elasticity, and then increasing different levels of trend inflation, right? That's what I showed you in the previous instance. Don't worry about this thing, but it's mapping that same sort of idea. What do we see? Blue line is trend inflation of 2%. The red dotted line or orange dotted line is trend inflation at 4%. So what do we see? Output losses. Output losses are rising, okay, when stickiness is more or the elasticity of substitution is rising, okay? And it's exponentially increasing at higher levels of trend inflation. So the higher you are, the worse it is, okay? As we increase levels of trend inflation, this is actually productivity losses, productivity losses. As we rising up, right, this exponentially increasing real costs on the economy at higher levels of trend inflation. We can do something sort of similar. Okay, this is effective labor demand. That's the supply that households would like to give. It's reduced by wage dispersion. If you look at the production function with technology and this effective demand, it's also worsened with price dispersion. So when inflation is 0 in this setup, that's 1 and that's 1 in trend. Okay? And we can also look at this composite dispersion where we combine the effect of both of these resource costs. Okay? What do we see again? Steady state output in percentage deviation terms. In steady state, right? So it's like long run. Rising again rapidly at higher levels of trend inflation. Don't worry about the middle one. We can see here what's interesting here, and we've looked at different calibrations and the sort of turning point shifts there for welfare. We can argue about the definition of welfare, etc. I haven't got time, so I'm happy to talk about it. But what we do see is that actually it's slightly positive, around 2% for at least for there, just below 2%. You're maximizing welfare. All right? But then remember, there's a consumption, labor, or consumption leisure, right? So you are losing some labor, but assuming that people enjoy that leisure time, right? But there's some interesting results. But that at least gets the picture that welfare is rapidly declining at higher levels of inflation. It gets worse really quickly. Let's just look at some impulse response functions. Okay, so we're going to look at two types of impulse response. So that's the long run story. Gains from welfare. Lower is better. Seems like slightly positive is okay. Okay, as well. Then we're going to look at the short run, disinflation policy. We look at two shocks. Monetary policy shock, so effectively a tightening. You can think about, okay, let's just look at a 1 percentage point increase in monetary policy. How do the dynamics look? We also look at a target shock, which is maybe a little bit more realistic. Okay, I will need to caveat this because this is still full information, rational expectations. So when the target shock occurs, agents in the model are now aware. And so they can actually front load the decision. But we'll look at a partial information scenario as well, just to sort of emphasize the sort of the staggered nature or the sort of role of communication. Okay, what do we see? So we've got output inflation, interest rates, and dispersion. All right? Black is 0% trend inflation. Then it goes 2, 4, 6 to the purple. What do we see? We see at higher levels of trend inflation, for a given monetary policy shock, right, the effect is larger on output and more dampened on inflation, right? So as you move to lower levels of trend inflation, the sacrifice ratio falls. That's also good for Chris and his team. Okay. And you see that it's exacerbated by, at higher levels in trend inflation, the dispersion associated with that. Okay, again, think about the price theory that I mentioned in the first slide. Oh, I can't go now. There we go. Okay, if we look at nominal rigidities, basically just zero trend inflation. This is what a standard New Keynesian model would look like. Okay. Then we, with nominal price and wage rigidities, then we say, okay, well, what about at 4%? Let's just look at 4%. We could have had 4.5, but 4%. Okay. We see that those nominal, because of the dispersion, the nominal rigidities are exacerbated. Not good. And then that's the blue line, and then if we add wage and price stickiness, this exacerbates it even further. So if you're not accounting for trend inflation, you're not accounting for these additional real costs or benefits, right? Because in the disinflation policy now, with a target shock, when inflation's lowering and you're lowering the trend inflation, you're actually mitigating some of those real costs. That's the point. Okay, maybe we can get back to the sort of communication story if there's questions at the end. Now I want to look at an inflation target shock. So effectively it's like looking at a permanent one, but you're just setting the error coefficient to like 0.999, okay? This is anticipated 8 quarters ahead, so 2 years ahead. So it's like they've announced it, and we have a scenario where it's, anticipated, and then we're looking at 0 trend inflation versus 4% trend inflation. So it's a negative permanent target shock, and effectively these are like our transition dynamics. So we can compare, look at the output gains, or the output in the black line, trend inflation. If we did our analysis without taking into account trend inflation, we would say output would actually fall. That's not nice. However, once we take into account of price dispersion, we see that at the lower trend inflation, you are reducing that cost effectively in the long run, which actually has this benefit for output. So it's mitigating that. Okay, inflation path the same, interest rate is front-loaded. This is why I think the SARB is already on the right path to reducing it to 3%. They've been arguably holding rates higher than what people want. This is also why I think the SARB doesn't follow a Taylor rule, and often we hear they're not following their reaction function of 0.5 response to inflation. Well, maybe they are at more 2.2. Maybe they're holding it higher. So the more hawkish policy, according to this model, is correct. But the SARB doesn't follow a Taylor rule. They discuss the realities of the world. So I think this is a nice finding. So they front load that a little bit, but remember, agents are expecting this. We can add the price stickiness dynamics as well. That does this sort of emphasizes the same story. Okay, this is a partial, again, sort of like a partial information story, where, what do I want to say? So here it's sort of unanticipated, okay, in the black line, the solid black line. When that 8-quarter period arrives, now everyone goes, oh, the target's changed. But then the full information, the rational expectations full information kicks in. So that's why you see a very sharp reduction in inflation, but it's contractionary, right? Or at least output relative to the anticipated version is lower. Okay, so that's the sort of stories that communication matters here. You have a smoother transition, the output losses will be less. Okay. I'm finished at like 20 slides, so 22 or 23. This is a little bit on the debt dynamics. Just have this one sort of insight here, or 2 insights. Here we can think about it, again, an inflation target reduction at different levels of trend inflation. Black is now 1, and then it goes 2, 3, 4%. All right? So let's say we had 1, or if it was 0, and the SARB, we know we committed, the government committed, the SARB committed to a lower inflation target, but we didn't take into account trend inflation, the gains. What do we see? In the black line, output is lower, debt to GDP, much higher. That's what everyone thinks. Yeah? That's the narrative. If we take into account the fact that we might be moving from 4% to 3%, all right, we see output gains, and that's coming through the dispersion reduction, okay? Although real debt burden is rising, the output gains offset it, and the debt to GDP ratio actually declines in the longer run. Okay, so at least we don't have to believe these results as being the results, but I think we've all missed these gains at a fundamental first principles level of a market-based economy, and the gains that could be had from lowering trend inflation so that the market economy can actually function. Of course we need government buy-in, I'm not going to get into that. Of course we need the government buy-in, the administered price story is important, the role of unions in bargaining, it's all part of the picture, but I think this is a really nice compelling result, time's up, that that I would like to bring into the discussion. I think we've broadly missed this, but again, if you don't believe me, go read also Scari's paper. There's some nice couple of other references that have come out. So yeah, looking forward to the discussion. Don't shoot the messenger. That's the main point. So prices are signals. Don't shoot the messenger. I did steal this from the price theory guys I follow, Brian Albrecht, and the quote earlier was from Alex Tabarrok. So I did steal that. I'm sorry, but it was good. Okay, thanks everyone. And then that's what we plan doing forward.